Hi guys, so in this video, the next video in the series, we're going to look at defining candle closes versus candle wicks. So that basically means that if a candle is doing its job, is it breaking above a previous high or low, or is it just wicking it? And this can give us again a good indication of how the market is going to behave within these different sections. Again, like I always say, this is not a guarantee, it's just a probability. So it doesn't always have to happen. But generally, when we go through, we're going to see that when a candle does its job, it's going to be protected as long as you have the market direction done correctly as well. So you could see here, this is actually a really nice one to see to start. So we could see here in this case, there have been highs and lows created within this entire range just here. This would have been a really tricky section to trade because you can see here with this break, oh sorry, wrong thing there, with this break of structure to the upside, or sorry, change of character to the upside, we're on a 1 hour chart here, 1 hour change of character, we have a break and close to the upside. So what does that do? It defines a strong low. So we have the low that created that change of character, price pulls back, and you can see here that it continues on. What you can see here though is price came down, failed to make a higher high, so this is a weak low because it failed to break this high. So because of that, price can run it. So if I take my line here, you can see price wicked it, but it didn't break the strong low. So that's a wick, and that does not give us a continuation. Because it wicked, then this high failed to make a lower low in this case, because that's our rule. A wick does not count as a break of structure. So what we do is we look at it, and what happens is the high that created that wick is now ran. So same thing, market moves up, makes a lower low, makes a higher high. It doesn't break that low, so that's just an anomaly there within the internal structure. Um, and eventually we get a breakdown then into a change of character. So I'm trying to find it here. You can see this low fails to make a higher high. Then we have a low that comes down. So here's a wick break. I would assume we're close enough to it. So we have this here. That's not a very strong break. So I know it does close, but it doesn't close with any kind of strength. So you can see the difference. I would consider that just a wick break there. And then the expectation is the low that created that is ran. So again, what I would be doing is trying to train my eye in order to see where are these breaks happening. So I'm just trying to find some examples for you here. And these highs are actually a good example. So we had a low that made a higher high. This high failed to make a lower low, and then this low failed to make a higher high. So this gets ran. So again, this is a weak low because it failed to do its job. Price comes down, closes it. But then the low next then before that is this one here. So you can see that price has basically broken and wicked this low. So our expectation is then that there's no other high in this leg except for this one. So we would expect this price to get ran, which it does. It gets wicked. And so because this low didn't do its job, it didn't create a higher high, our expectation is that this will get ran, which it did. So you can see, I know it takes a lot of practice to generate this information, but this is just something that consistently happens over and over again in the market, especially if you're ranging. It gives you a really good idea behind where you should enter and where you shouldn't, and why the market is ranging, and why you might not want to touch it. Like sometimes when I see something like this, and you can see you're marking off highs and lows, and you think, well, maybe because this happened down here, it might just wick this high and look for a reversal. So I could then, again, I'm not going to go too deep into this one here, but if I can find this high, where is it gone? Up here where it wicked, we can find an entry off this. So you can see here, price wicked. Where's the low that created the high? Is a very, very difficult one to spot here, but it's there. We have a high here, and where's the low? The low is here. So this is why we have to train our eye. And then you can see because price broke that, we can see where does price come back up to, which is the order block, which would be within this range here. If I look at that, maybe a 5 minute, we're going to see it a little bit better. There's a change of character there. So price comes up, 1 minute change of character. I could enter off that if I want to, or again, if I want, I can wait for price to come back up into the order block, which is here. And then I can just enter my short order off of that. I could say we put it here, put our stop above the high that did its job, which is this one here, and then target the lows that failed to do their job. Or if there was a higher time frame one, say if I went up to 1 hour there on this range, and I'll say, well, what high failed to do its job, which was the high down here. So if that was the case, I'd be looking at a 32 to 1, and that would take me how long to hit? So that would be a day trade to hit a 32 to 1. Again, following the rules, there's no reason why you can't do that. I know that seems like really optimistic, but if you have your higher time frame predefined within these levels and you get an entry, why the hell would you not let it run? I would pretty much guarantee, if I look at this on a 5 minute chart going the whole way down, that there isn't a defining reason to exit the trade. So again, say we're looking at it from here, we have a low that's violated and closed, pulls back, fails to create a lower low, fails to create a higher high, so my stop could be above this high. Then this high creates a lower low, stop go, I'll just show you where my stop will be moving. So I'll be moving my stop above this, makes a lower low, fails to make a higher high, makes a lower low. Where does my stop go? Here. Makes a low, fails to make a higher high, stop goes here. So you're just moving your stop the whole way down. Makes a low, fails to make a higher high. We have our change of character here. Stop moves down, goes down all the way, low, high, makes a lower low, so my stop will go here. Again, just following the same rules that I've been talking about the whole way through. Sometimes it makes me fucking sick that it can be this easy if you just have the fucking patience to learn this shit. It's that easy. Makes a lower low. We were at TP there anyways before I had to move my stop. So look, you know, I'm probably going to go on a rant here, but there's so many Instagram guys out there that are saying, oh, you know, it's so easy to make money and all, and none of them have a fucking clue how the stock market can run. They don't know any of this information. This is so specific to what I do and what traders that are based around these areas do. They're not spoofing you with indicators. There's no indicators on my chart. I could use a change of character and a break of structure indicator if I want to. I'd rather do it myself. But you know, if you take your time and be persistent in learning the processes and the rules to apply these structures in here into your trading, it will build confidence in your own ability over time. And that is what you need in training. In trading, you can't be approaching the stock market just going, I'm just going to short here because, you know, some asshole said to me, oh, you know, when you get a doji candle, like a fucking doji candle, there's a doji candle. What doji candle do? Absolutely nothing. It didn't even create a higher high. It's absolute nonsense. Doji candle. All you need to do is, you know, look at the trend and follow the trend and all. Like, trends fucking break all the time, and you know why? It's because they don't know where the highs and lows are. Like if I draw a trend line here, you can say, oh look, there's touches here off the trend line. Trend line breaks, people go long here because they don't have any context, and then they get absolutely smashed. What you need to do, honestly, is just have your rules in place and learn how to apply them on an extremely consistent basis, and understand that the market is going to repetitively do these things over and over again. We identify the higher time frame areas of interest based on historically what the stock market has done, and then we execute based off the rules, the systematic and repeatable rules that we have here. You want trading to be boring as hell. I don't sit in front of the charts all day. I basically map out my stuff, and then I go and live my life. I have alerts set on my chart so that when price reaches a level, then I'll sit down and start watching it. But until it hits an area of interest for me, I have zero interest in what's actually happening there. So it's really important for you guys to understand that if you can, like I said, learn these rules and learn to execute them, learn to see them with the naked eye. Like, to be honest, most of the time I don't even really need to draw the lines out here. I do it because if I leave the charts, I want to be able to come back and reference some point here. But don't trust anybody. Anybody that says I think it's going to do this does not know what they're talking about. I have proven it over and over again. And one thing I'm going to say, I am never going to brag about like profits and say, oh, here, this is what I bought. I bought this in a Lamborghini. I'm not going to flex on any of this. Yeah, sometimes I have big wins, and that's fucking fantastic. And I'm really happy that I've made it to this point after all the shit that I've gone through. But it's not a flex. You see these guys doing it, their rentals and stuff like that. It's not a flex. A flex is being able to get out of employment, being able to live your life the way you want, maybe being able to support your family, pay off your mortgage, take your wife or your girlfriend out of work, go on nice holidays, have your kids go to a nice school, have them go to college, whatever it is. That's a flex. Objects and all that shit that those lads are flashing, fuck that. Sort your life out first before you start worrying about buying objects. Learn this shit, nail it down, because I guarantee you, this is my flex. This is my flex showing you lads that this shit works. I'm not going to be going around flashing profits. I don't need to. I can prove it on a daily basis that this process will generate profits if you learn it and if you stick to it. And if you can prove me that I am talking shit, prove it. I will ask anybody to do it any day of the week, and I will prove them wrong. So any ICT trader, any other fucking nonsense that's out there, saying, oh, supply and demand, or I think market's going to reverse here. Why do you think that? Because it's sold off too much, or it's overbought or oversold, or fucking RSI fucking indicators, or EMA has crossed. Garbage. Absolute fucking straight up garbage, non-stop. I'm sorry for cursing. I get pissed off and emotional about this because I got caught up in all that stuff before, and it pisses me off that there's idiots out there that don't know what they're talking about, and they're selling shit to people, and they're making tons of money, and people are getting fucking screwed. This is not it. This is the shit that you need to learn. Thank you. Sorry for the rant.